So today we're talking about the question, what is risk management at a bank? And this here is a very simple example of a real estate bank. So in this case of a bank, let's say that the owner or the owners of the bank have put 20 million euros into the bank, right? And there are also people who have their savings account at this bank, and the savings account add up to 80 million euros. And what the bank does is it takes this money, so it takes this 100 million euros in total and invests this in real estate. So our real estate assets of the bank are worth 100 million euros. So this is the setting. And now let's try to imagine that there's a real estate bubble and the real estate assets that the bank has bought lose in value. So let's say that those assets were originally worth 100 million euros and now they're worth 90 million euros, right? Because of this real estate bubble, right? What happens now to the equity and liability side to the bank, right? Our bank still owes $80 million to the depositors. So what happens is that the equity declines in value and that our equity is only worth 10 million, right? Because my debt still exists, right? The loss in value has to be mirrored by a loss in equity, right? And let's now say that our real estate bubble is really intense and the real estate assets lose further in value. And now they're only worth 80 million euros anymore. And what would happen in this case is that the equity is wiped out totally, right? So my real estate value is totally financed by the debt value. And now, if our crisis intensifies and my real estate assets lose even further in value, maybe they go to 70 million euros, the bank runs into a problem, right? You see that the debt is larger than the asset values that the bank owns, right? In other words, if all my depositors want to have their money back, the bank is screwed or the bank is bankrupt. And this is what risk management is really all about. Risk management wants to avoid bankruptcy, right? And with this simple example, you have seen how risk management achieves this. Risk management tries to understand how risky are my assets, right? How much value decline is possible with my assets. And risk management tries then to assess how much equity do I need in order to cover my risks, right? So risk management is in the center of assessing risk and then assessing how much equity is needed to cover this risk, right? And in the next videos, we're going to look at the various methods that are used at banks to understand how big this risk bar is, right? And if I know at a bank how much my risk really is up to, I can then go and establish how much equity do I actually need in order to avoid bankruptcy in the most probable cases.